I recently came across a few articles and resources that spoke of the dividend triangle, a concept new to me, so I thought I'd share. Basically, the dividend triangle is a simple means to assess a company's financial health using three metrics, each making up one side of a triangle that includes dividend growth rate, payout ratio, and dividend yield. The idea is that those three metrics together will provide valuable insight into a company's profitability and their ability to sustain their dividends. Let's break down each concept a little bit further, and we'll start with dividend growth, which very simply is the percentage by which a company is growing the dividend that they pay to shareholders each year. Let's use Snap-on as an example. They have a 5-year dividend growth rate of 14.59%. The idea here is that if a company consistently increases its dividend over time without negatively impacting other financial metrics, it suggests that the company is generating profits through revenue growth. Investors should confirm this by reviewing revenue and earnings per share growth. The second side of the triangle is dividend yield stability. Let's pause for just a moment to describe dividend yield for any new investors. Essentially, it's the dividend rate, which is set by the board of directors, divided by the current share price. As it relates to the dividend triangle, a stable dividend yield within a historical range indicates that the stock price is likely growing in line with dividend growth. If we continue to use Snap-on for our example, the last 5 years shows a fairly consistent dividend yield, but we know that as share price fluctuates, so does yield. So any short-term fluctuations in dividend yield are just a factor of price movement. And looking at Snap-on again, we can see that that yield is pretty flat over time. The next side of the dividend triangle is the payout ratio, and according to Investopedia, the payout ratio is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. If the dividend payout ratio aligns with the company's targets, it suggests that earnings have increased, supporting the assumption of dividend growth. And when we look at payout ratio in that same time frame, we see stability overall with just a slight jump up in 2020. But otherwise, that payout ratio remains flat. I want to take this a step further and introduce the concept of the Chowder Score and the Chowder Rules. This was first introduced by a Seeking Alpha contributor who went by the name of Chowder, who created this metric to evaluate dividend growth stocks using two key factors, both of which are part of the dividend triangle: the current dividend yield and the 5-year dividend growth rate. To calculate the Chowder Score, we need to do the following. Find the dividend yield, which in the case of Snap-on is currently 2.49%, and we also need the 5-year dividend growth rate, which for Snap-on is 14.59%. The final step to calculate the Chowder Score is just to add the two together, which for Snap-on would be 17.08%. But it turns out there's rules around the Chowder Scores. Rule number 1, if a stock has a dividend yield greater than 3%, its Chowder number must be greater than 12%. Rule number 2, if a stock has a dividend yield less than 3%, its Chowder number must be greater than 15%. And finally, rule number 3, if a stock is a utility, its 5-year dividend growth rate plus its dividend yield must be greater than 8%. So because Snap-on's yield is less than 3%, our goal would be to look for a Chowder Score greater than 15%. So Snap-on meets the criteria with its score of 17.08%. Now let's talk a bit further about why these rules are in place and talk for a moment about the goal of Chowder. Now I'm here over on SureDividend.com, where we can see that the goal of the Chowder Rule is to create a long-term compound annual growth rate of over 8%. The Chowder Rule applies both margin of safety and total return thinking to accomplish this goal. For stocks with a dividend yield over 3%, a 33% margin of safety is used. Instead of hoping everything goes smoothly with a stock with a projected compound annual growth rate of 8%, invest in stocks with a projected compound annual growth rate of 12% and give yourself a 33% margin of safety. The margin of safety is expanded for fast-growing, low-yield dividend stocks. If a stock has a dividend yield below 3%, the required projected compound annual growth rate is expanded from 12% to 15%, giving you a 47% margin of safety. The institution behind this is that fast-growing stocks will likely have their growth slow at some future point, so a higher margin of safety is required. Because utility stocks typically have higher yields and slower growth rates, they're highly regulated and typically enjoy regional competitive advantages from strong barriers to entry, and as a result, the margin of safety on utility stocks is removed using the Chowder rule. Utility stocks need only have an expected total return of 8% to pass the Chowder rule. Of note is that Chowder recommends using the Chowder rule last. That before employing the Chowder rule, one should pinpoint businesses of superior quality, guided by excellent management, that are suitable for long-term investments. So of course, now that I have my head wrapped around the dividend triangle and all the Chowder one could ever need in life, I wanted to take a peek at how my portfolio stacks up to all of the Chowder rules. So here's a listing of my portfolio. Left to right, you'll see the ticker, the company name, the current share price. Then you'll see the three metrics that make up the dividend triangle, so the 5-year compound annual growth rate, the dividend yield, and the payout ratio. And finally, you'll see that I have already calculated the Chowder Score for each of my holdings. Now, if we apply the rules, we can see how things will stack up. And if we start with rule number 1, we're looking for companies that have a dividend yield greater than 3%. And within my portfolio, that consists of 15 holdings, but only 7 have Chowder scores greater than 12%. Also of note is Next Era Energy actually falls under rule number 3 because it is a utility stock. But it does meet the Chowder rule because its Chowder score is 14.92. This brings us to rule number 2, which is the remaining 24 holdings in my portfolio because they all have yields less than 3%. For these companies, I'm looking for Chowder numbers greater than 15%, of which 16 meet the criteria. So have you all heard of the Chowder scores, the Chowder rules? Do you just love yourself some New England clam chowder? How does your portfolio chowder? Leave me a comment below. And fun fact, 15 of the 18 companies in my Big Safe Dividend portfolio meet the Chowder criteria. So if you haven't seen that series yet, be sure to take a peek at those videos next. Triangle. To calculate the dividend